really hard, right? Squeezes are very hard to define when, when it, because it could go. And I think the one dynamic of a price squeeze. So I think 200, getting to 150, 200, I don't think that should be in the, base case kind of scenario here, right? That's like that. I don't think that'll be hard to do. But the harder part to understand is, I think, how much that squeeze happens, because by definition, a squeeze, you can get that much higher than the market anticipates. And
Hey guys, Capital Cosm here. Before we start this video, I just want to let you know that I believe that we are on the cusp of a major uranium bull market. Now, these things don't happen every other week. The last uranium bull market peaked in 2007, the one before that in 1978. So when these things happen, you've got to take advantage of it. And how explosive are they? Well, you've all heard the stories. Uranium skyrocketing from $10 to $20, all the way up to $150 in these uranium bull markets. Where will it go this time around? Well, we don't know. We'll see. But you've got to take advantage of the opportunity. What better way to do that than to leverage Justin Hune's Uranium Insider newsletter? You get access to his monthly newsletters, his webinars, his stock picks, his portfolio, all of that stuff. You get access to guests that you may not see on YouTube. You get access to having them ask questions that you may not see anywhere else. So I highly recommend, if you're going to take part in this uranium bull market, you check out Uranium Insider. Link is down in the description box below. Be sure to click the link. There's quarterly plans, there's annual plans. So if you're kind of tepid, you're kind of hesitant, you could always go with the quarterly plan. Kind of test things out, sample things out, see if you like it or not. But the way I see it, guys, you've got to pick the right stocks. A lot of these uranium companies are not going to make it to the other side. Now, and Justin Hune's uranium portfolio has outperformed the likes of URA by a significant margin. Since 2019, it's up 5x from where it started. So click the link down below and we'll get started right now on the video. Thanks, guys. Hello and welcome to Capital Cosm, everybody. Today I have a very special guest on the show. It is Mr. Thomas Grizzle, Tommy Gun Grizzle. I just made that nickname up, by the way. Thomas, thanks for coming back on the show. Thanks for coming on the show, I should say.
Thank you very much. Well, we'll have to do this regularly now, right?
Yeah, I mean, we've just been riffing off each other for about 30 minutes now. So I mean, we've got really good chemistry.
Well, it sounds like the next time I'm gonna have to come in studio in Atlanta. There seems like there's gonna be a food review. There's things to do. I'm gonna come through Atlanta for the next one.
Yeah, bro. I mean, I'll pull up a chair right here, and we can just look at we can look at charts. We can eat Chinese food. We can just do it all.
Let's do it, man. Chinese takeout charts. Hey, that's a show in itself, man. That's a spin-off.
Oh, that's actually pretty good. Chinese takeouts and charts, or charts and Chinese takeout.
That's it. Yeah, we gotta get it phonetically right? Charts and Chinese takeout.
Well, we've got to execute on it really fast for someone else steals it.
Oh yeah, for sure, man. Well, the nice thing is it's a subgenre of a subgenre. It would have to be. We would know the culprit pretty quickly, and then do you remember the episode of The Simpsons where Homer got it was from Microsoft to shut down his internet company? I don't know if you remember. It was a classic episode of like.
Which one was it?
So Homer decided to start like an internet company of some sort. Literally, he didn't have it was like during the .com boom. He didn't have a computer or anything.
Oh, man.
He just had
I used to be a big watcher of The Simpsons. I never saw that one. I'm going to have to go find it on YouTube or something.
Oh, you have to, right? And so he's got his little desk, a little cup with pencils and sitting there. And then someone bangs through the door. It's Microsoft. They take everything away. It was like,
Microsoft is ruthless, bro.
Oh, ruthless. It was like, that was like, there, in terms of like the Simpson, peak, like those things were just incredible. I was like, oh man, this.
Yeah, I know the Simpsons are still ongoing today, but I don't know like how popular they still are.
Yeah,
especially with like Zoomers and stuff, like the younger generation. I don't think they're too into the Simpsons.
Yeah, you got to kind of tap out at some point. It's like, leave the glory years. Seinfeld did it right. Seinfeld kind of set the tone for what if you have a culturally iconic TV show in America, you do a Seinfeld.
Yeah, you leave at the top. It has a lot of parallels with investing, right? It's when
Yes.
you need to sell at the top, not when you've reached your peak and it's come and gone for many years.
Bingo. You know what? You know what? We should call it the Seinfeld, man. Like honestly, we like everyone in commodities. You get
Let's just memify all of these investing tropes,
totally
bro.
like,
I'm telling you.
bro. Listen, if you're not, the challenge with commodities, and we've all been there, right? Is you overstay your welcome, and you're high on your own supply. You're drinking, you're just enjoying being in the pantheon, and you're doing the victory lap. It's the best time. And in the moment it's hard, but it's always there's different strategies that can mitigate it. We just had a whipsaw on lithium. I think we did come out well, but did I get enough out of the lithium miners? We reduced our exposure heading at the start of 2023, which is great. But did I wish I took more off the table? Hell yeah! But now I'm coming back to that other side of it. When you're feeling the giddy highs, and and you need to do the Seinfeld line. On the other side of it, it's like, it's those cult shows that are on TV and everyone knows it's great, but no ratings, and you're the TV producer that's got to keep putting money, knowing that
Yeah,
this thing could blow
you've got to
up.
be the trendsetter. You
Hell
can't
yeah.
be following the herd. I mean, it's got to be
No,
it's got to be inherent in you as a person to be kind of
100.
kind of aloof to what's popular, but also have the
Yeah,
balls to kind of stick your neck out.
totally. And I think that's kind of, and so we have an ETF, the disruption at a reasonable price, Grizzle Growth ETF, and the disruption at a reasonable price. It really applies to across the spectrum. We got a barbell strategy where we own tech and we own commodities, and the thing about it is at a reasonable price. Obviously you want to be part of something that is landmark and changing, and I think but I think putting the valuation lens on it just really gives you protection. Not that in these sorts of situations, what ends up happening, especially with disruptive technologies, and with hot commodities too, is the money ends up going into certain buzzy names, right? And you see it time and time again, and just having a valuation filter is an incredible thing, right? And so I think we're in an incredible place where before you had Grant, you had the Benjamin Graham straight value investing. I'm looking at stuff that's trading at a discount to price to book. Hey, listen, if I'm even lucky, I get it for below cash. Like the things that he was like that, that was incredible type. That was the lens and strategy. But that's the time I had to take a train to go see the thing. I'm like, the world moved a lot slower, right? And so these kind of those kind of anomalies existed, right? Then you move to a world of GARP, right? And there's no question that even when you look at Warren Buffett's investments, he started to take a DARP lens, particularly with a GARP lens, particularly with Apple, right? So the idea is, okay, listen, I can't just value it on trailing earnings. I need to look out a year or two or whatever, right? But I think we're now in the period of DARP, which is I have to separate this from Kathy Wood's twisted space shuttle view of disruption. I'm saying just the view of disruption now is you have to take a bet on something that's going to have cash flow inflection in 4 to 6 years. That's and those are the visionaries in the equity market. You got to take that lens, and I think a lot of traditional value investors have a hard time looking out that far and taking those kind of bets. It's kind of you and I think the idea is you got to just believe, and I know we're going to get into it, but I think uranium is a classic DARP bet, right? We know what's happening now, and some will say, oh well, things are frothy and chemical. I'm like, you're not looking far enough, right? And that's the DARP bet.
Yeah. I mean, we've been talking for what 10 15 minutes now. I forgot to ask you. Go ahead and introduce yourself to the audience who may not know who you are, Thomas.
Right. Yeah. Hey, listen. As far as I'm concerned, we got what was it? Chinese takeout and charts. Yeah, we have a show. We have a show. We have a new show to kick off. No,
Yeah.
so Thomas George, I co-manage the GRZ's. Sorry, the Grizzle Growth ETF. The ticker is DARP. That and we're and with that we're partnered with incredible partners, Cambria, Title. Yeah, we're excited. It's we've really defined what disruption at a reasonable price is in the category, and that's been we've had that running for over 2 years now, and it's we're happy to say we're the top disruptive fund in ETF in that category, but and trying to convert hearts and minds about people who are thinking through the Cathie Wood lens and trying to say, listen, there's the science fair project stuff, and listen, I don't. Cathie's got incredible the franchise she's built, but I just think the lens that she's looking for these stocks is something akin to venture capital, and that doesn't work in equity investing, right? And the people who know very well are commodity investors, right? Everyone who's been invested in a hope and in a dream penny stock, mining company, knows the dynamic of big pipe dreams, right? But the point is that you got to take a look at a lens that's closer. 5 to 6 year cash flow inflection. I think that truly is the opportunity. It's a barbell strategy. We have tech. We're fully invested on the AI side. And AI is big boys game. Like in terms of it really is capital is the differentiator. So
is there any more juice to squeeze in AI at the moment?
Oh, huge. Like from a medium long term perspective, I just think the productivity that we're going to see is just gonna be mind blowing. And I think like the Nvidia naysayers got ripped start of the year to say to put it mildly, but a lot of my conversations with commodity focused investors, it's actually kind of interesting is no one's kind of putting the pairing together, right? What you can't have the future without the commodities that power the future, right? That's
100%.
And I think what's interesting is that you have commodity investors not invested in tech, like that actually is a thing. Like that's actually like anti-technology, like almost like just like saying, listen, I just don't want to like not involved on the tech side, and I find that
you're betting against the ascent of man, essentially, which has been ongoing for thousands of years.
Bingo. And I think that's a regressive way to think about things. Like, why not invest in the greatest productivity revolution to ever happen, technology, right? Across the spectrum. So there's that. So I spent a lot of time talking about that, but I think the other side is equally valid, right? Many very tech-focused investors, like let's use the memed up kind of Tesla investor as an example. They cannot get through their head. So we do not own we have a de minimis weight in Tesla, 1%, just in case like any of these robot pipe dreams come true or whatever, right? But the bottom line is like we're not invested anywhere near like what Cathie or other disruptive peers are, and we don't own any other EV companies because our view is that the ROI capture in electric vehicles is going to be at the mine. We truly believe that it's not going to be at the EV, like that's going to be the commoditized side is at the EV manufacturing side. We're seeing that right now. I don't know if you saw that it was it Hertz that's selling a third of their fleet of Tesla.
That was a couple years ago, wasn't it?
Oh no, news just came out
again.
So they're kind of like liquidating. I see if we can pull that up, but that was kind of the news that was coming up yesterday, and then someone I'll try to pull up the graph just like on pricing for EVs. Like it was a
they're selling 20,000 EVs to buy gas cars instead. So here, let me.
And so, but the point is that it's a hard game, right? And so I just think that side, like we're still structurally very bullish that penetration of EVs continues to get higher. But I just think the risk is really on the downstream side of this, right? And there was big news today. If like Samsung took a 9% stake in Canada Nickel, and that's pretty profound. Like Canada Nickel is going to have one of the they're the next big giant nickel producer on deck globally, and by definition a juggernaut in North America. And something we've talked about earlier prior to going live was this. We're seeing a rejigging of supply chains in such a profound way that I think people are still getting their heads around. So how that conceptually fits in investment frameworks. And when I say if you're in battery metals, you're investing across, you're thinking about it. So if you're a Tesla investor, I implore you to think far more dynamically about technology and the fact that the bottleneck is not going to happen at your car level. It's going to happen at the manufacturing, at the mine level. But more importantly, you're going to see incredible dynamics play out where you're going to have from mine to battery, right? And that is like, and so Samsung and then other investors in Canada Nickel include Agnico Eagle and Anglo American. Like truly, this is setting up to be, I would say, one of like a template for how the future of integrated supply chains in battery, mine to battery will work. And I think that's something really dynamic. And I'm going to pull up a chart. Let me try to share this here. There we go. And we talked about this. And I saw this yesterday, Brent Donnelly, and I was trying to search his name, but I don't know why anyone would ever put their name backwards and upside down. But there we go. I was like, let me try to search Brent Donnelly, but
I think it's because so the way I think the Twitter algorithm works is that the more time you spend on a tweet, the more it gets pushed out by the algorithm. So the more time you spend trying to read his name, the more likely the algorithm pushes his tweets, right? That's pretty smart.
Backwards, upside down, and left, right. You know what I mean? Like, I was like, because before the show started, I was like, I gotta find this guy's tweet. I'm like, Brent Donnelly. I'm like typing, and I'm like, what the heck? Anyhow, but he has actually great content.
I mean, look at that. He's got 146,000 views on this tweet.
Yeah, listen, how many people trying to spell his name? Trying to get it right. But this was a powerful graph, and this is from the good folks at Alpine Macro. And I thought this is a powerful, profound chart, right? So this is looking at Chinese foreign direct investment in China. It's just been a one-way track down. And then the other side of that is U.S. manufacturing investment, basically picking up the slack and going the other way. And this, I think, when you look at profound trends, this is probably the most dynamic of them all. And I would truly say that mining investors, particularly as it relates to supply chains and into batteries and electric vehicles, this is something pretty incredible where you are going to see much more of the battery manufacturing happen onshore, where the cars are built, and we're seeing a tectonic plate shift to take away China from as the core manufacturer of batteries, right? And right. I know there's charts out there. Sorry, I'm just going to close that. But I know there's charts out there that just show the level of concentration of battery and all battery metal production as well in China, right? And I think that that's a dynamic.
And isn't a lot of it moving to what is it, Vietnam or Mexico?
Well, so you're seeing this kind of disintegration where
going all over the place.
And you're just starting to see supply chains get much more regionally focused, and all of that. That chart really speaks to the fact that just means all of the gains that we saw from a perspective of pricing, if you will, that China offered, like lowest price, just send it out. where you're going to now the prices go up because you're paying this, you're going to pay a premium for this regional supply chain exposure, and that premium will end up being to the benefit of the miner, and that I think is an incredible tailwind.
Interesting.
We're still, it's still being conceptualized, but I think this investment by Samsung into Canada Nickel proves that they're committed. It was 18.5 million, I believe. It's a significant investment that they are committed to getting this mine up and running and integrating that into their battery chain.
Yeah, I mean, I'm looking at the chart now. They've run up, what is it, almost 100% since November. I want to say. I
Yeah,
mean, granted, that's the bottom.
well,
They're up
it's
8% today.
8% today on this news, and then just before just at year end, last trading of the year after market, they announced Agnico Eagle had taken a block in the company as well. So it's I just think that this is it's a fascinating time. Where Mark Selby is CEO there. He really is a visionary, right? And we've had him, we've had him at multiple conferences that we've held, and our battery metals conferences, and he's just an incredible source of insight into how the world is developing. And he was talking about the types of, he was always in Korea, always in South Korea, always in South Korea, and I'm like, oh, I think
Trying to get that Samsung deal.
yeah, I know, right? I'm like, but just thinking at it at very high levels on that kind of deal making is truly, is truly visionary, right? And because these are this will set the blueprint for other companies to do similar sorts of deals. And so the big question for me, we were talking about the the Seinfeld, the dynamic, but the other side is obviously we're looking at the value.
Did we talk about
side
that on or off camera? I can't remember.
I don't remember.
Should we go over it again?
You know what? I honestly look. What? It's incredible whenever you press record, but I don't even know. It's been a great conversation, nonetheless. But what was it? Yeah, no, I think we said it on camera because I was talking about the Simpsons, and But this concept is leaving it at the top. But the other side of it is just trying to find those gems that the undervalued gems, right? And I think the other side of the lithium, and now where we sit right now, I'm super interested in lithium. That I think that everyone's that's the time you need to go in, right? It's everyone, no one's interested anymore. But the other side of it, I look at Rio Tinto, I look at BHP. These companies are they think in they don't think in years, they think in decades, right? Well, why, M&A has a classic pattern, especially with big companies. They get in at the top, the deals are done at the top. That's kind of like a classic scenario. But they have an interesting opportunity if you pull up both of their decks, right? You look at their metal profiles. What's missing? How is it possible that you have this massive gap in one of the most important metals, lithium, in your portfolio? And I personally think there are a lot of it. So I think the large miners, Albemarle, SQM, are cheaper, cheap. But I think with respect to there's interesting development opportunities that they can absolutely put a flag on. They're going to get they're getting them at a fraction of the value that they were trading at a couple of years ago. I just think it gets super interesting. These sorts of things, the way they happen is you don't know until you know, and it's that first M&A deal that everyone's like, wait a minute. You sharpen your pencils, and by that time, everyone's like, oh, find me a lithium comp table, quick, right? But the one thing that I learned, one of my mentors kind of ingrained in me. He was like, bear markets are great, man, because when things are washed out, because that's the time you do your homework. then you put it away. It's not necessarily put the trigger, or you can put a flag down, but you know it pretty well, right? You know it pretty well, and once the catalyst happens, boom, you can just like you know exactly the names that are happening. You've done the work in the bull market.
It also cleanses the sector out of bad names as well. Like that's what happened with
Yes.
a lot of the oil services companies, and it cleansed out a lot of these bad high debt companies. And so at the end of it, at the end of the bear market, all you've got is not all of them are great, obviously, but
Yeah.
you've got a much better filter on what's available.
It's a great point, right? And that cleansing is part of the that's the kindling for the next bull market, right? Because you can't have these deadbeat companies around.
Yeah, and then as you go up the bull market, then you get more shitcos in the mix because everyone wants to, like uranium, for example. We're gonna have more uranium companies by the end of this bull market.
Yes,
Way
yes,
more uranium companies that
yeah,
have nothing to do with uranium.
exactly. And I know there was a popular Twitter thread going on before New Year's Eve, before New Year's and stuff, and on uranium and the I think I like this opportunity the most in terms of catch up trades for equities because the commodity itself has ripped. And you have and Cameco as a bellwether has ripped with it. I actually have a great attribution. I'll try to. Oh, do you know what? I'll bring it up. Actually, I thought this was
Go
pretty
ahead.
powerful. Yeah, so I was wondering if I tweeted it, and I actually did. So let me bear with me. I'm gonna find it because
Yeah, so we're
I
going to
think.
talk about uranium, what the people want.
Yeah, let's go. Okay, so here
I'm a
we go.
stall for Thomas right now, but as soon as he finds this chart, whatever he wants to share, I'm going to let him cook.
Yeah, let me go. Yeah, so you know what? I like doing this sort of stuff. It's kind of share my screen. Boom, there we go. Hopefully that's not like overwhelming the screen. I just kind of it's the only way it could look. Can we see all that? Hopefully.
Yes, sir.
Okay, nice. Okay, yeah. So this is oh sorry, this you know what? I didn't do the full year, but this was actually one day, but this is the attribution for a day, and it kind of like it was interesting. We had a day this week where basically small caps were ripping, and the point the critical thing I want to make here is that the small caps have lagged large caps, and this large cap is basically it was a day early, it was a day earlier this week. Large caps were up, were up 2%. That was Cameco, but the small caps were up 4%. And the not classified is actually the SPUT. So so what you kind of want to see here is I wanted to show a longer term version of that, but the main part that I really want to highlight now, I'll bring up another chart too, but the main part you really want to highlight in this is that basically you're seeing the change in performance, and here we go. This is the one I wanted to bring up.
Can you actually pull up that chart again really quick? I just want to run
Yeah.
through some of the metrics there and make sure everyone
Do you know what?
understands.
That was a one-day attribution.
Okay.
But let me set the stage, and I think I think I have to set the stage, and I think that
yeah. I mean, uranium broke $100. The URNM ETF, the URA ETF, all the miners are running like crazy right now.
Oh, good. Yeah, good.
Making all-time highs with URNM at the moment.
Yeah.
You find it?
Sorry. Yeah, I got it. Yeah, there we go. Yeah, so there we go. Yeah, so this is basically, and if we have a Substack, grizzleresearch.substack.com, where you can find our work. What we like to do is deeper dives with a quantitative lens, and we look for anomalies, right? And we look for opportunities. We look through a quantitative lens with a value focus. That's our edge, and then we'll do fundamental work after we narrow down the quantitative universe, right? So with uranium, we went back in time, now 20 years, right? And we categorized by market cap, and like just got the whole body of data in the entire sector. And this is the kind of work that you kind of need to do, right, to understand. Uranium does there's a chart. We can bring that up. I'll bring it up later. But the one defining trait of uranium is that when the price goes up, it doesn't just gently go up; it spikes, right?
Yeah.
So every time in history when uranium goes up,
now.
Exactly, right. So you get squeezes, and some commodities it's less pronounced. In some commodities, it's like uranium. You get these incredible squeezes, right? So here's how it works, right? So you get and the way the squeeze works is gently, gently, gently rising, and then lid goes off the top, right? Which we're seeing right now.
Hmm.
So the point that I want to say is you got to look at past cycles to understand how this trades within the underlying equities. The narrative on the left chart is July 2003 to March 2007. What's interesting here is through this period, um, Cameco was outperforming small caps, and the way I define small caps is the bottom 50th percentile of uranium by market cap,
Right.
outperforming, right? And that that's very similar to what's happening right now. There's a frustration generally among there was last year for sure, and at least we're feeling better now, but there's a general frustration in the small and mid cap camp of just this bellwether just getting all the capital, right? And that's actually how it plays out. That's how it plays out last cycle. But what's interesting here is you reach this point where bang, and then it's just where the small caps, the blue line, just rips, right? And that
So Thomas, quick question.
Yeah.
Is this looking at price appreciation over time or market cap appreciation over time?
No price.
Right. So you took like the average of the bottom 50th percentile or something like that?
Yeah, so these are portfolios, right? And so I'm taking the bottom 50th
Okay.
percentile and rebalancing quarterly, right? And so just saying, listen, if you kind of popped it, like if you popped out of it, then you're not going to be in the bottom 50. But every quarter, I'm taking the performance of the bottom 50th percentile, equally weighted, and I think equally weighted is like my preference to do these studies, right?
Yep.
You just go equally weighted just to get a flavor of like how this performs, right? And so yeah, you just generally see lagging until a point where basically you get a blow off the top, and then ultimately at the end of the bull market, you get a place where the small caps have significantly outperformed Cameco. And let me so that's by the numbers, but I think you have to put a context behind it. And in Canada, we're fortunate to get we have a lot of veterans in the commodity industry, and I've been involved since 2002 in commodities, and one of the defining traits there is that it's this basically run of capital, right? So right now you're getting generalists just throwing money at Cameco, and I'm not saying Cameco will necessarily go down. I'm just saying on a relative basis, the small and mids have some real torque behind it. But what ends up happening is there are a lot of people who've been on the sidelines and had no exposure to uranium, right? And so what is their propensity to own the large cap bellwether or to look smart? And I'm talking about institutional managers to look smart and find the value play that's under the radar. The propensity is to go into the names that have lagged or and have perceivably more value than Cameco, and then you get this dynamic which I call like the pitcher effect, and I'll show it to you in a bit. But this idea is that within the uranium small cap space, we know there's going to be a bunch of names that are probably aren't going to make it to the finish line. But among the real genuine invested names with defined resources, there's only a limited amount of market cap in those names, and you have this picture of capital and call it all the money, frenzied institutional money getting in. And also we have retail as well. There just isn't enough. Like there aren't enough of them, and you get this blow off the top, right? And so the dynamic here, then when you kind of pull it over to where we sit today. Now, we did this analysis in September. Obviously, this is playing out, right? So our view there is like, listen, you're going to see some level of Cameco on a relative basis starting to not perform as strongly. As the small caps, right? And so let me find another. I'm gonna find another chart.
Pull back up really quick. I just want to make a point there.
Yeah. Let me grab that again. Yep.
So if you look at the left chart, you'll see that the blue line overtakes the yellow line very briefly. It seems maybe for about 6 or 7 months, right? But on the right-hand side, the blue line overtakes the yellow line, with the blue line being the bottom market cap stocks. They
Yep.
overtake the yellow. So is that essentially? It seems like they're both kind of they're tracing each other, but it seems like the chart on the right is set up for a more explosive move relative to the blue line outperforming the yellow line.
Yeah, I'm definitely of the view that it will be
Yeah,
explosive. Yeah, and
because
I agree.
because
I agree.
the smaller cap miners outperformed Cameco from July 2003 all the way out to maybe 2004, maybe.
Yeah,
Whereas the small miners in our current bull market outperformed Cameco from 2020 all the way up until 2022.
yeah,
So that's maybe a 6-month time frame outperformance
yeah.
versus a 2-year time frame outperformance.
No, it's
And
a great
so,
point. That's a great point. Like, there's that muscle memory of like, hey, listen, there was a good time here.
yep. And then Cameco went on to overperform the bottom miners for a couple years.
Yes.
We're currently in that process now. But then what
Mhm.
you'll realize is when this thing really hit into gear in 2007, the miners began to outperform Cameco. And
Correct.
the gap here today seems like, okay, so you're sitting at index at 200% for the miners, and you're sitting at 450% for Cameco. The gap seems okay, so it's a little bit of it's somewhat comparable to where it was in 2005, 2006 over there.
Yeah, it's
So
comparable,
yeah,
and I think the obviously the trajectories are going to be there'll be a level of difference, and
right.
but the main part is that the does the disconnect still hold? It's happening. The disconnect is there. There's no question. And then B, is are the is the kindling set for the blow off the top move in uranium, and so
Right.
in as we follow everyone on Twitter, we know that this is happening, right? There's
That's
no
actually a pretty good
question.
indicator that I've never heard anyone say is that when the bottom or the lesser mining stocks begin to outperform Cameco to a significant degree. So when that happens,
100%.
that's probably a signal for a top or a local top.
Yeah, so that kind of like, we look like I spent a lot of time looking at market internals, right?
Mm-hmm.
Particularly intra-sector. And I just think like, for me, just like I'm just dialed in. I'm like, I see when I start to see that kind of, and that attribution table was like this day, I'm like, this is the day that you just see, like, you see that frenzy, you know what I mean? Like, you see that
Right.
frenzy of the money starting to leave sput, the uranium trust starting to leave Cameco, and Cameco's obviously still up. Like, I don't think, but I just think on a relative basis, you just start to see that incredible performance. And I think, next time I come out, I'll
Yeah.
pull up a
Because
Bloomberg.
essentially what this tells me is that we're still in this thing for the long haul because Cameco is still overly outperforming the miners.
Yes.
If the last bull market is anything to take away from, it's only when the miners begin to significantly outperform Cameco as to when we should start thinking about, maybe we've topped.
It's a great point, Danny. Like, yeah, 100%, 100%. Like, we're still early, right? And I think that's where we want to be, right? I was excited about the frustration that was. I love Twitter because it's a phenomenal community, right? But also you get a lot of voices of like, there was a general frustration that you can you can palpably take in of the small caps, and then I forget the guy. Anyway, this guy wrote this super long thread that was useless. I forget if Macro Bear or whatever his name is. I could care less. But irrespective, I kind of read this. Now I'm like, I don't even know. Like, why are you taking 40 tweets to write this stupid thing? We can probably do it in 2, and you're not even using any like really tangible data. Like, it just was kind of like a weird thing. And then I put out a reply to him. I'm like, yo, this is like, I didn't call him, whatever, call him out or whatever. But I'm just like, I'm like, if you want to see, cognitive dissonance is like, yeah, I'm bullish uranium, real bullish uranium, and I hate the miner, like I hate the small cap miner. I'm like, in what world? If you've been in commodities, you can't suggest that you're going to be bullish to commodities and then small mid just do nothing, like, and to the point of I'm going to short this stuff, like that to me just feels like, especially from accounts that don't have their uh you know long written things with names attached. I'm like, yeah, I mean, like that feels like someone's trying to play funny with the market. And I maybe not, but but the main part about it is it's like there's and he ended up deleting the whole thread. Like it was just drama. Like the guy's a drama queen. I'm like, dude, just stand on your own. But the bottom line is this is hard data. We went and got the data. This is factual data. Throwing around shit goes and this, that, the other, slandering a sector, just saying badly run this. Yes, fine, but like show me the data, right? And that a lot of these guys just don't have it. Because they don't actually do the work, and they write eloquently. And the thing is that the macro tourists kind of just pop in, pop out, and write well, and but questionable. I never see any of their performance, right? The proof is in the pudding is when you actually have numbers to back, verifiable numbers for your track record, and that
Yeah.
that's hard. I have incredible respect for Cuffy, and he's got published numbers, right? We've got published numbers. Anyone who's got published numbers, good, bad, indifferent, incredible. It's a level it's a real gravity there because to do that it's what they're putting on the stake.
Yeah. Well, I have good news for you though. There is one
Oh,
person who's endorsed uranium recently that I think you're gonna really
oh,
be happy to hear. It's
who's
Mr.
that?
Jim Cramer.
Love it. I love it,
I
love
mean, it doesn't get
it.
any better than that.
Oh
Yeah,
man,
yeah. I think he endorsed UEC last night or the day before.
there you go, there you go. It's and so I forgot to include the most important thing. So I'm sorry, I was just searching for this right now. Boom, boom. Let me. Sorry, bear with me. This Zoom sometimes like this Zoom thing. Yeah, gotcha. There we go. Sorry. Um, okay, so this is actually the final piece de resistance. And so what we ended up doing was then saying, okay, listen, we're gonna look deeper into
Oh
this, right?
wow.
So remember this chart that I was showing you? I'm like, okay, listen, these small caps. I was like, I'm looking for anomalies in small caps, and the simplest way to look for anomalies in small caps is to take a look at the whole market cap range, and then take a look at the bottom 50 percentile, define that as small cap. But kind of interesting here. So
The mid
this is that
caps.
same graph from 2003 to 2007, but now I'm looking at 20th, 25th percentile to
Mm-hmm.
75th percentile. Call that the middle. Still small cap because you have this weird in uranium, you have a couple juggernauts and the rest is basically small cap. But you're taking this kind of middle meaty area. And what's different about this? So you're leaving out the companies right at the bottom 25th percentile, and you're going up market cap a little bit. So you get this 25th to 75th middle area. What's interesting here is this, by definition, are companies that have defined resources, right? So this
Yep.
isn't just a a PowerPoint and a dream, if you will, right?
Yeah.
This
So
is real companies. Yeah.
yeah, so I've got the market total market capitalization of all the uranium companies on the screen here. It's well, not for the viewer to see, but
Yeah. Yeah.
I
Yeah. Yeah.
have a pool $65 billion. Now,
Yeah.
22 billion of that is Cameco.
Mm,
12.5 billion of that is Kazatomprom. And
yeah. That's right.
then you got your next gen at 4 billion, etc.
Yeah.
But just about half of that total market cap is just Cameco and Kazatomprom.
Bingo. Right. And so and then when you group it by and when you slice it up by deciles, then all of those guys are going to sit like right. It's going to be real chunky right at the top. So even when you cut at the 25th percentile, that's small cap, and all the way to 75th percentile is small cap. But it's a defined small cap that actually has resources. So then you're like, okay, listen, now I'm going to start to value these companies on even a resource, start to look at all these other dynamics too. And so we go through the full analysis, and we highlighted 10 names that screened really well, right? And so in our Substack, we're going to do an updated one. So maybe I'll send that. I'll send the updated one. I think we're gonna have that actually out pretty soon. So I'll keep you posted. Well, we've been kind of noodling on that and working on that, but we're expanding the universe, and just we're getting more detail. But I think this is the dynamic that this 25th to 75th percentile is very unique because it never and there probably is some underperformance here relative to Cameco. Game has been so strong, but irrespective, look at the blow off the top period. So even if I'm playing,
Yeah.
if I'm playing for blow off the top, do I go small cap and just, spray it across the board small cap, or do I get laser focused and, focus on this dynamic of companies that have resources and,
Do you have a 2020 to date version of this chart, just so we can compare where we're at?
no, so we're yeah, you know what, I will pull that up. That's so we're updating that, and it's worth doing. Yeah, so you know what, I'll let me get it for you, because so this is the historical one. We just kind of
Yeah.
pull that piece.
Because
And
the reason why I asked is because it seems like from my chart reading, Cameco is still overperforming not just the small caps, but also the mid caps.
yeah,
So I'm just trying to figure out, like, where are we exactly? If we had to pick a point where we're closest to on this chart, it doesn't seem like it's 2006, 2007, because
no,
the mid caps still haven't run yet.
no, and so I personally think we're in a place right now where this cycle, the slight difference in this cycle is that this 25th to 75th percentile. Last cycle it was just a steady state outperformer, and then you have a blow at the
Mhm.
top, closer to 2007 peak. But here you're gonna see underperformance relative to chemical. It's just been so strong.
Right.
Right. And so this is an interesting dynamic where I think you get it gets super interesting for sure.
Yeah. So we've had uranium run all the way up to $100. How
Nice.
high do you think this thing goes? Because I just did a video yesterday where we looked at uranium price in gold, uranium price in CPI, uranium price in M2 money supply,
Yeah,
and the
yeah.
upshot of it was, depending on what you look at, it's anywhere between $200. It's equivalent to $200 uranium if you price it in the CPI, all the
Hmm.
way up to $450 uranium if you price it in gold or the M2 money supply. So, what's
Yeah,
kind of your take there?
yeah. So pricing blow off the tops is really hard, right? Squeezes are very hard to define when it, because it could go. And I think the one dynamic of a price squeeze. So I think 200, getting to 150, 200. I don't think that should be in the base case kind of scenario
Okay.
here, right? That's like that. I don't think that'll be hard to do. But the harder part to understand is, I think, how quick, how much that squeeze happens, because by definition a squeeze, you can get that much higher than the market anticipates. And right now we've been in a fairly steady state, grind higher to 100. It hasn't been a squeeze by any means, and that to me feels great. Like, you know what I mean? Like, I think the longer this march up happens, the better it'll be
Yeah.
for the sector, right? Because once you get squeeze dynamics, obviously the equities are going to move. Like, things just start to move really quickly, right? And I just, my hope as an investor in the space is that it's you're getting more steady state. You're obviously going to get some of the squeeze dynamics. It's just you want that squeeze to be sustained, and I think it would, and I think that's going to be the difference this time, is that you'll probably get some squeeze that pushes really high, and then you're going to get a steady state that is going to be higher than the 100 for sure. And so that net of it is, it's all very positive. And I think, as there are a lot of good reasons why nuclear should be a part of the mix. It truly is. When you think about the opportunities to have a future that looks dynamic, and we're not breathing polluted air. It is a combination of nuclear and natural gas. There's no other questions about that. Like, those two, oil. I like oil, but I don't know fully. If I were to tell somebody, okay, listen, give me your probability of, like, what oil consumption is going to be 10 years out. A lot of people have, you'll get some bullish responses, but you'll get some pretty, like, you'll have a
Yeah.
pretty wide range of responses, right? Now, if I ask you the same question for natural gas, there is no wide range. It's up. It's up only, right? Like, natural gas is the fuel where, once you reach a level of income per capita, the first thing you want is your air not to be like a freaking polluted soup. Like, you're talking, like, I still remember going to China. 20 years ago, and then India, like these places, like Delhi is stifling. Beijing was stifling, right? And I can tell you, certainly, China has made a huge move, right, in those last 20 years with respect, with a focus on health, right, and air quality. Like those are things you demand, right? And now India is poised to do the same, right? And I think that those are the straightforward steps, and how has China delivered that? That's been through a combination of increased natural gas. Uh, um, Power generation and nuclear, right? And I think you're going to continue to see that. And the nice double whammy you have with nuclear is that you're getting a renaissance in the developed world.
Yeah, and unlike coal, not coal, but oil, and there's coal as well, and natural gas, etc. It's uranium or nuclear power isn't just an investment to make money on. It's actually an activist investment, because you're helping develop this alternative fuel source that can lift mankind up to new heights, but at the same time, it's incredibly cheap, and you can make money
Yes.
off it as well. So it's the best of both
Yes.
worlds.
No, for sure, right? And I don't really subscribe to the like I know there like I think that we can have our cake and eat it too. And there was a great book, kind of focused me up on all of this, by Amroy Lubbins. He coined the phrase negawatt, and it really got me thinking about how we can get to a cleaner planet, without sacrificing capital. And let me put that into context, right? When I do something very science fair projecty, I know that my dollar to dollar cost to reduce carbon is going to be expensive. But you know what's like got a negative pay, like basically like a significant ROI is, and like a payback immediately, is putting in LED light bulbs, right? Like that, those sorts of negawatt opportunities are what we should be chasing with the precious capital that we have. So, we're incentivizing things that I think the capital would be far better spent on a combination of efficiency plus nuclear and killing coal, like, and having natural gas be, like, so let me put it this way. And I think the subsidizations that we've given to renewables, particularly wind and solar, it's been a lot of money. And America does not have a manufacturing capacity. Like, it's all of that, basically the solar panels we buy from China. Like, so the money has, like, the incentives have really gone to another country to develop their manufacturing capacity. So what it was supposed to do to even enrich our respective economies, it didn't even do that. So literally we incinerated capital. What if we took that capital and we said, listen, why don't we just create a pool here to say, listen, the developing countries, for every coal plant you shut down, you can retrofit that to a natural gas plant, and we have here's the beauty of it. We wouldn't even have to subsidize it. We just, you'd be just a micro subsidy, because because the big oil would definitively do that. Like, the point is you make it like you give an incentive for developing countries to switch off of coal. If we just killed coal, right? And so you took that subsidy pool and you spread it around natural gas and nuclear, I think we'd be in a far better place than we are today. Far better place. And I think those are the problem with environmental thinking and policy. It's science fair, magic, rabbit out of the hat stuff gets all the attention. Gets the champagne environmentalists pumped up,
but they're not grounded. Their heads in the
yeah,
clouds.
no, totally. And pragmatic solutions, I don't know. You know what I mean? Like, to me, that kind of thinking is so, it's not going to lead us to a better place, and it incinerates valuable capital that could be incentivizing nuclear and natural gas.
Yeah, 100%. let's go ahead and shift over to another commodity, if you want to call it that, that's been making
Yeah,
rounds. Bitcoin.
yeah,
Bitcoin's been
yeah.
making some pretty good gains lately, precipitated from the Bitcoin ETF that has gone live and approved. Has it gone live or has it just gone approved?
No, no, they were trading yesterday. Yeah,
Okay,
live.
they were
We're
trading
live.
yesterday.
Yeah, 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 yeah.
Bitcoin is currently at, I want to say,
Yeah, if you can pull that up, that'd be great.
44,000. Okay, so it's actually
Okay,
come down a
pull
bit.
back. Yeah, pull back a bit. Yeah, so our structural view is very simple. Yeah, it's not Bitcoin. Yeah, there we go. Yeah, and we've had a strong move in Bitcoin, but I think the importance of this is that I'm gonna pull it. I'll get a good chart for you, and I'll put it up. Let me bear with me. I'm gonna let me find it. This I think this chart kind of defines Bitcoin and how it moves.
Yeah.
There we
And
go.
for those who may not know, because I know a lot of my audience is commodity focused, it may not be privy to or aware of what's going on in the crypto or Bitcoin space. Essentially, you had
Yeah.
this Bitcoin ETF approval happen on Wednesday. And
Mhm.
what's so significant about it is now it enables family offices, institutional investing to come into Bitcoin where they may not have been able to before. And so the idea is now you have access to all this extra liquidity and capital. Um, and that, as you saw there, Bitcoin is sitting at 44,000, pretty good rise up from where it was several months back
Yeah,
in the
uh,
30s.
yeah, for sure. And the thesis is very simple, but you have to kind of put put the ruler around the kind of capital inflow that will come into Bitcoin. So let me just give you a little story here. Looking at the period of February 2020 to 2021. But the most important thing about this graph, it shows you exchange traded volume, and also the Bitcoin price. And what you notice is there's a feature here, and commodity investors can understand this too, right? We're kind of seeing this play out in uranium. Is the dynamic of Bitcoin and Bitcoin holders is they are fundamentalists, right? And so if you know the term HODL, which is basically the word hold, but the part of that is that it's the diamond hands. It's this whole idea. The
Yeah, hold on
whales
for
just
dear
don't.
life.
Exactly, the whales don't sell, right? And what you end up getting is when big players and even smaller players don't sell, but then a large amount of volume comes in, as we see here. So anytime there is a spike in volume,
Mm-hmm.
what you get is a spike in Bitcoin. Similar
Right.
squeeze type of dynamic, right? Again, so it happened in 2018. It's happened in the last squeeze. What's interesting is that when the price goes down, it's on low volume, which correlates to the fact that they aren't liquidating, right? So it's like, so what you end up getting is when Bitcoin goes down, it's on lower volume. So
It's
you're not
hodler selling.
exactly. So it's not, you're seeing low volume of selling, but the price falls significantly, right? And so what's interesting is last year the price went up, but on low volume, because what drives this big volume, right? And so this is the graph here. What drives the big volume is money moving into institutional product, right? And I'm going to pull up another graph.
Which is what we
So
also saw with uranium over the course of the last year and a half. I don't know if
bingo, yeah,
URAs has been skyrocketing up with institutional money. That's we're actually at all time highs with like URNM, URA, not URA, but URA is up, I think, to 52-week highs, etc. But
yeah.
not on the backs of retail, but on the backs of institutions.
100%, 100%. And so this dynamic is pretty incredible. Like, where basically in 2 years, like, so there was a flow of institutional money into institutional product, call it ETF, not in the U.S. but in Canada, Europe. 12 billion of capital went into in 2 years, went into Bitcoin ETFs, and that really precipitated the move up in Bitcoin over 800% in that period, right? So that's that highlighted thing, right? So really what it comes down to now is to think, okay, well, I know that this is my bogey is, call it 10 to 12 billion. To of capital is enough to squeeze Bitcoin, right? And so now you look at, okay, well, if I know that that's what drove the last bull market, how much money could come in now? If you were to take the Canadian market as a pretty good corollary to what could happen in America, Bloomberg's done some good work on, just showing the, Bitcoin assets relative to the overall ETF market. You're looking at 75 billion that could ultimately come into Bitcoin in net new money. 75 billion. Okay, my bogey is 10. I know net 75. If we were to say apples to apples, same sort of penetration would happen in America. But then another interesting dynamic is, well, then they say, okay, well, listen, that's over time, right? Over time. But what actually happened in Canada is that money actually came, all of it came like the first year. So 65%, the largest Bitcoin ETF, I'm just going to pull up this one more.
Also important to note, a dollar coming into an asset or like Bitcoin, for example, isn't a dollar increase in market cap. It's actually more than that. So every dollar that comes in asset, in regards to Bitcoin, I think the last number I heard was like it's 20x that same dollar. So $1 increases the market cap. $1 into Bitcoin increases Bitcoin's market cap by $20 effectively. So that's $75 billion. Sure, Bitcoin is a $1 trillion asset. You might think, okay, well, a few $1 billion isn't really going to make that much of a difference, but you've got to take into account, once that money starts to flow in and gets traded, it's going to bid up the market cap of Bitcoin simultaneously.
Yeah, which is what we saw in that last dynamic. Right? As soon as you get big chunky flow, you good things happen, right? And so the purpose Bitcoin ETF, and the largest one in Canada, it's 2 billion. Basically 65% of the units created. So the way ETFs work is that you have units, and then as soon as new people buy, new units are created, right? Mm-hmm. And so what this graph is showing you is unit creation over time. And what you see here is the first year, basically that's when 65% of all the units that are in existence in that ETF were actually purchased. So there's a
point of diminishing returns.
Yeah, so just really to kind of square it all off is what we're suggesting is that a large amount of that money comes the first year into these products. So if you go 65% times 75 billion that ultimately could come in, you get something like 50 billion potentially. So we think right now consensus is like 10 to 14 billion is going to come first year. That's enough to squeeze this. We think it could be closer to 50 billion, but irrespective, anything above the 10 billion bogey, I think moves Bitcoin. And the other big part about it is I will share one more thing. I'm just going to find it because it was a tweet, but I thought, the amount of, so basically you have 11 ETF providers at the starting line at the same time with Bitcoin ETFs, and they all want to be dominating. But so how are they getting, so it's going to be an incredible drive for market share. There's already an incredible price competition already. So I want to say 5 of these ETFs have zero fees for the first 6 months. Like they're doing everything to incentivize this. And then net, there's also an ETF with 20 basis points of fees. But bottom line is this is one of the most competitively priced products. What does that mean for net flow? So when you have a competitive product, a competitive category, there's multiple products here, and you have all of them at the starting gate at the same time, all of them going out to the field like with what I call, Bitcoin marketing porn. The incentive is there's never been a blitz like this in marketing of ETFs. And I'll just show you something just to kind of give you an idea of the type of things that this is what BlackRock is going to the street, going to advisors with. But Bitcoin's performance compared to major asset classes, this is just kind of showing where Bitcoin is every year. Bitcoin, right? And again, I'm not a big fan of this sort of stuff, because obviously, you
go from 0 to 1. It's like a near infinite move.
Yeah, but the point is just hey, listen. Put 2% of your assets in Bitcoin or 1 or whatever, because listen, it's been out of 10 years, 7 out of the 10, it's been the top performing asset class.
And you know what? It seems like the years that it's not a top performing asset class, it comes in 4-year chunks, which coincides with 1 year after the halving cycle.
Yeah. That's a good point. Great point. Yeah. So it kind of, it's a great point, right? And so we've just done 1 year, right? And so we potentially have 2 more years. Great point. Great point. This actually, you know what? This actually, it's not like like that's a great look at it.
So it
Great
seems
point.
like the best time to buy Bitcoin is 1 year. So 2025 is the next halving cycle. Best time to buy would be probably 2026 after everything kind of fizzles out. If
Yeah.
history's any indication.
Yeah, so this is kind of I think the setup is good, and but the other important point is that the equities have leverage to this, and there are certain equities that are sitting on like 25% of their market cap is in actual Bitcoin, and Scott's highlighted a couple companies that basically they'll be mining 60% of their market cap by the end of the year in Bitcoin. So again, this dynamic in disruptive areas where underfollowed smaller market cap companies just don't get the love compared to like a Marathon Digital and Coinbase, etc. And I think it behooves an investor in any sort of disruptive asset class to be like, and mining, so just go where the eyeballs are, right? Because that's where the opportunities are, and that's where you'll get insulation too, right? Because if you valuation is insulation, right? And just so so the DARP strategy we launched in December 2021, so we had the full glorious year of 2022, which was brutal for growth, but the DARP lens, we were down 19% that year. ARK was down like 55%, something like so freaking crazy. The Nasdaq was down 30%, and the S&P 500 was down 19. Like we were down in line with the S&P 500, mind you, with the way more risky stuff, right? But the other side of it is we acknowledge that commodities were part of DARP, and we own natural gas, right? And we owned miners, and so that all it all ended up like our prism into DARP, into what we felt was a vision for disruption made sense. And last year was good too. We ended up just over 30%. So it's I think it's an exciting time. That especially with AI and everything happening, and I just think as a commodity investor, it doesn't get better. I know obviously we're looking at a geopolitical situation with oil that's going to get pretty volatile.
Yeah, I mean, before we wrap things up, what are some of your predictions for 2024?
So I think it's going to be a good year. I think I think if the Fed's anytime the Fed takes its foot off the once the Fed stops hiking, I think good things happen always, right? And I think that'll be a great space. I still love the gold miners, right? And I know that's we believe that gold will continue to be an incredible asset class. And I think the reality about where we're sitting is that there's two paths, right? Once you kind of reach this level of debt in society, you have two ways to fix it. You can take your medicine, or B, you inflate your way out of it. If there's one thing that we know about the political class, because these are all political decisions, right? But one thing we know about the political class today is their desire to take any sort of bitter pill is zero to none. The populist element of it is significant, and everyone's looking at best maybe a year out. So you don't have any of those, you really don't have any real long-term thinking. And when you look at like who's in power too, like having old geezers running countries, it's geriatrics. It's just terrible. Like mind you, like I think actually Trump, has the virility of a 30-year-old. He still cracks me up. And that
I'm telling you, it's the Coke and Big Macs, Coca-Cola and Big Macs.
That's like, what?
They've been lying to us this entire time, telling us McDonald's is unhealthy for you. No. You got to eat McDonald's every single day, and then you'll live to be, like Trump.
This idea that junk food, like you look at like diet Buffett and Munger, like it's just like I know these guys don't have good diets, and they're still. What you realize is what gives you longevity truly is just keeping that freaking ticker working, keeping that brain going. Yeah. keeping that brain going, and
A lot
having
of it's
this.
genetics too, by the way.
For sure, and like, but I just don't get, like, it's interesting, right? You got an example with, you just see, like, what's interesting is on the buy side, particularly, I've noticed that uh buy side investors look old, look very young, and then they sustain looking old forever, and then they outlive everyone. I think there's something interesting in being like, a deep thinking investor that just gives you this kind of hunger to just continue to stay on, and stay on the board. Like, you never say, like, like, if you're to look at Buffett's physique or Munger's physique, you're like, yeah, these guys got,
It's nothing you want to replicate. Yeah.
no, but they're top ticking the 90s, man.
Yeah. Yeah. But I bet if you were to ask Warren Buffett if he'd trade off like $50 billion or all of his wealth just to get back 20, 30 years of youth, he'd definitely do it.
Oh,
You could just make
sure.
it all, you could just make it all back up again.
Oh, totally. Like that kind of is, it's yeah, I mean, like, and everything that's happening right now with respect to us understanding better how our bodies work and function, and I think we're in the middle of a lot of revolutions. Like, we own Compass Pathways, a psychedelic company, psilocybin. We're big believers that the way we've treated mental health, like, I just dole out a bunch of pills,
Oh,
and
it's like 20 years of therapy in like 4 hours.
incredible. It truly is like an
And
absolute game
you come
changer.
out of it knowing yourself on a very intuitive level. It's not
Huge.
like, it's one thing to know something on an intellectual level. It's another thing to know something, at a very like intuitive level. Like you just know it.
100%. And that kind of deeper level of, like, understanding of your situation, coupled with a great therapist. I that idea of band-aiding with pills, it's just going to look like, it's going to look so dumb, on so many levels. And it's exciting. It really is exciting, the chapters we're turning, with respect to mental health, physical health as well. All of these verticals will, continue to, like, there's nothing but excitement ahead of, for us, with respect to how we're going to get that much more powerful with information, where, as it relates to AI, and then, in addition to that, you have an exciting future if we get it right, which will require governments to think longer. And I really do believe they'll at least get this one right, with respect to nuclear power. I think that's not a nice thing. We have to do it right. Like,
Yeah,
the
gun to our
future.
heads. Like,
Yeah,
do or
the
die.
future. Natural gas is a bridge fuel, but the future has to be looking like George Jetson. It has to look like, and that future, they never had smog in George Jetson's world. Like, there was no haze, right? It was clear skies. Nice.
Yeah. Great note to end off on. Thomas, go ahead and tell the folks watching us where they can find you.
Oh, yeah. Well, thank you so much for having me on. A great conversation, a good laugh. And you know what? It's great insights too. It's to find us, obviously we live on Twitter, Thomas G _ Grizzle. Also, you can find my partner Scott W _ Grizzle. But if you want to find any of our research, it's grizzleresearch.substack.com. That's where you find all our work. We also have a phenomenal partner at Grizzle, Chris Wood, who is one of the top strategists, global equity strategists. He writes a note for us weekly, so sign up to the list because you get it for free, and it's a great macro note, and always good insights. And then our ETF, disruption at a reasonable price, ticker is DARP, trading on the NYSE, and that is, we've had that up and running for 2 years. We're partnered with the good folks at Cambria Investments. Matt Faber, I'm out here in LA, working out of their office. Matt's phenomenal. You definitely have to have one. He's just launched
Ooh, Mark. Who?
Med Faber,
Med
phenomenal.
Faber.
He's great, man. So he just launched a fund. It's a micro and small cap a shareholder yield fund, and I think that actually is pretty powerful. Like, I think it's kind of like, we're kind of like looking at it. It's a super interesting strategy, looking at that, like, if you're a resource investor, you're a small cap investor without a doubt. And I think having a quantitative lens and understanding that better just equips everyone more. It's great. And then the other thing I have to plug because I just saw it. The and Answath here. I'm gonna actually bring it up. Let me bring it up because I thought this was like I'll leave it with this final here. Bear with me. I'm just gonna.
We're gonna look at
here.
some
Yeah,
jets and clear skies.
no. Actually, I thought this is like for anyone in investing. I thought
That's a good follow, by the way. That Capital Cosm guy at the
yes,
top.
yes, let's go. let me. Where was this? Okay, here we go. I thought this was so. Aswath Damodaran, the GOAT evaluation. Did you know that his whole corporate finance and valuation and accounting classes are all free? He gives it all away. That's like in all the course content and material as well. It's profound. I'll click on the link. This is like, and he goes through the whole thing. But get this, like, so it's going. You can attend. So he goes like classroom format, zero cost, online free, or you can pay 22 or 2,200 if you want the NYU certificate. But more critically, look at all this stuff: accounting 101, foundation of financing. You can boom, and you get the webcast, you get the whole thing, you get the slides, you get the whole like. Literally,
they're really. I mean, dude, man, there's really no excuse anymore for people.
None.
Like
there's
you have
no
everything
excuse.
at your fingertips.
Totally. And like there's so many charlatans talking like, oh, democratization of finance, blah, blah, blah. Listen, this guy's actually the real deal, giving you knowledge and insight, and you learn from the best. And this, when I think about disruption, real disruption as it relates to like education, why wouldn't I want to learn from the best? Why do I want to learn from a tier 3 person that I'm going to have to spend money with when the best is saying I'm giving it all away? And I was just like, I immediately just sent it to my son, like, listen, take your time, go through this. This is the best in the world teaching you, to your point, no excuses, right? And so I know there's probably, everyone's on a path of learning, right? And some have knowledge in certain areas and figuring it out on the others. But if you're an investor, just don't and you don't have that full body of financial literacy, the financial knowledge on as financial statements, analysis, corporate finance. Like, this guy's giving it away for free. Yeah. You got to do it.
It's like learning basketball from LeBron James for free.
Yes, yes, and it's just like I'm like, that's phenomenal. It's like, and you don't have to go for your MBA. Like, we're gonna be in an ex MBA society, right? Where X, like, all these designations mean squat. I have my, I have my CPA or whatever. Like, that was all like, you get your CFA because you had to do it. But I'm definitively of the view that your chops will be defined by what you do on social media, the analysis 100%. That you bring. Right. And who am I looking, like, where do I see the next generation of talent? How am I going to find them? It's not some fucking cheesy email in your inbox. Hi, I'd like to introduce myself. No, it's going to be like, yo, this guy is grinding out on social media. He's putting in the reps, and like that to me excites me, right? Where like when you talk about like, breaking down, coming back to no excuses. There's no excuses for anything anymore, right? Oh, well, we're born with a silver spoon. Yeah, listen, doesn't really matter. Can you put in the reps on social media? Can you actually spend the time to analyze the sector and opine and look at dynamics? Do it. Like that. Like, there's nothing stopping.
Yeah. So I mean, you look at the 1900s, or actually go before pre-20th century. It was pretty much the age of governments.
Yeah.
20th century was the age of corporations. 21st century is the age of the individual.
Amazing. Love it. Yeah.
Throughout time, we continue to decentralize and decentralize and decentralize. And the way it's shaping now, the 21st century moving forward will be the age of the individual. So do you have a presence online? Do you have a social media presence like you alluded to? Are you self-sufficient? You've got to be more than just a wage slave. You can't just be sitting around, taking it easy, especially if you're young. Like, I get if you're old, you're 60, etc. You've put in all these hours. It's time for you to ride off into the sunset. But if you're young, like in your 20s, 30s, etc., I mean, you should be out there creating a brand for yourself. You can't just take it easy and just be like, oh, well, I'm just going to earn 100 grand doing my 9-to-5 job.
No, it's like, you know, in there you have an opportunity to do the job, whatever that job it is that you love, and learning from the best, right? Because either they're giving it away for free, or either you're in the mix in social media and learning and actively putting in your opinions, you know, spending the time, doing the work behind the scenes, and then coming back stronger. It's just super exciting. Like, you know, that it was to your point, there was gates like to knowledge, right? And those gates are all gone, right? It really is. I think it's just so exciting, and the way we're really seeing it play out. I'm a big believer in Substack and the power that has, right? And people publishing, you know, for themselves. Is that I truly believe differentiated research. Sell side will always exist. Sell side research, you know, Merrill Lynch, et cetera, et cetera. But the value of that research will continue. It has fallen significantly already, but it will continue to fall because the smart guys and girls will end up publishing on directly to their market. Like, look at Lynn Alden. She's a juggernaut, right? Like,
came out of
like,
nowhere in 2020. I remember
like,
her ascent. I remember watching her from the very beginning.
Incredible, right? And I think just, you know, and to your point, what is it, because she was on Merrill Lynch? Like Savita Subramanian, like, she's phenomenal. She's one of the great quants on Wall Street. But again, she, like, that really is because she, like, you know, we heard of her because of Bank of America Merrill Lynch, right? But like Lynn, this is a personal brand she built tirelessly through building research, opining on social media, and being that showing that hunger day in, day out, and you know, just being a juggernaut.
100%.
It's exciting. If you're not inspired by what's happening in the world today, like, you know, help yourself, man. Like, you know, there's nothing that can help you, because this is just so great. So many great opinions. But that all being said, I know social media can be a drag sometimes, and I know all that. But, like, you know, stay on the positive track. Stay on, like, expanding your mind, and like it's just an incredible time to be alive.
Yeah, I mean, there's a lot of doom and gloom out there. I mean, you look at 2020. Like, remember all the doom and gloom in 2020? I mean, how many people just panicked and just kind of, you know, whichever side of the aisle you were on? I mean, there's a lot of anxiety. So a lot of people just doomed away 2020, where they could have been investing, putting in capital, you know, that was the time to actually get in. When there's doom and gloom, I'm not saying that there isn't doom and gloom. There's definitely a lot of doom and gloom out there. But in times of uncertainty is when the iron is hot, is when opportunity arises, and you've got to pounce on that opportunity.
100%. Like, and that really is, like, you know, and that's, you know, and that's kind of like, you know, always just keeping a cup half full, you know, like keeping a positive mindset to say, you know, there's clearly, you know, there's challenges, but where can I find the opportunity in those challenges? And that's really, like, you know, it's so many people got caught flat-footed in during COVID, right? And you know, so many people will continue. Like, I think that is the nature of behavioral finance, which is very these types of reactions are the condition kind of leads you, like, there's that turtling, you know, the euphoria, like, as an investor, defining, you know, being, you know, calling the Seinfelds and, you know, leaving at the top, if you will, and then, you know, searching for those nuggets where it's an unloved sector. You know, these are defining traits that just take time. Like, you know, like, no matter how long you've done it, no matter how long, you just have to continue to search out for the opportunities.
Yeah, and it's something that a lot of people struggle with, because, I mean, even with myself, you know, it's easy to get wrapped up in thoughts of, well, you know, it's 2024, you know, we've got this thing with Russia and Ukraine, we've got this thing in the Middle East, you know, Korean Peninsula is about to pop up. I mean, what's the point of all this? We're just going to go to World War III, and we're all going to get recruited and drafted, and we're all going to die in some foreign land.
Right.
So, but you can't think that way. You can't think, because it might not happen. You've got to take advantage of the geopolitical uncertainties. And so, like, if you just get, like, caught up, like, and say, again, 2020, a lot of people thought COVID was going to be, you know, it was going to kill everyone. A lot of people thought that, you know, that there a lot of different theories out there. Yeah. But, like, a lot of people just froze where they were into in doom and gloom. You can't do that. You've got to keep expanding regardless.
For sure. And you know, and that you know, that seriously is, you know, that dynamic of getting frozen in these kind of, which is like, I'm a big believer in gold and in holding its value through inflation, but I think falling into the you never want to fall into the trap that, like, the whole world's going to implode and I'm going to be the one guy standing up.
Yeah.
Like that, that's why I like gold mining, because it's a positive. It's like, you're getting more ounces out of the ground. You're not just bunkering up, right? And I believe that's actually happening with a lot of Bitcoin holders as well, where they're just bunkering up. They're like, oh, I got my Bitcoin, and I'm like, great, but like, I'm like, listen, it's
I'm not saying don't bunker up, but don't take your eye off the ball at the same time. Like, keep going, keep moving forward.
No, for sure. Like, you can have but don't forget that this world is filled with opportunities, right?
Yep.
And that's the other part of it, right? It's but yeah, no, it's oh man, it's been a great conversation, and thank you so much for having me on. Capital Cause, man. Thank you, man. I appreciate it.
Yeah, man, you got it. Thomas Grizzle George. I like to call him Tommy Gun. Tommy George.
Boom, 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 boom.
Exactly. Just spitting out rapid fire insights.
Oh,
damn.
Yeah. Oh man. Well, thank you, man. And we'll look forward to doing it again, hopefully in person. And here's all the uranium bulls. That's been a great run.
Yeah, we're still hanging in there. Things looks like it's continuing to rise on up. But regardless, guys, thank you guys for watching. If you enjoyed this content, be sure to leave us a like, comment down below, subscribe to the channel if you haven't already for more content like this. And with that said, I will see you in the next episode. Bye, y'all.